Fixed or variable is the question I get asked more than anything else right now. And in 2026, the answer is genuinely different from what it was a year ago. Because here is what happened. The Bank of Canada cut rates 7 times between June 2024 and September 2025, bringing the policy rate down from 5% to 2.25%. Everyone was cheering, yeah! But then they stopped. And they've been holding at 2.25 ever since. Meanwhile, and this is the part most people are missing, fixed rates have actually started going up. Today, the best 5-year variable rate is around 3.6 to 3.85%. The best 5-year fixed rate around 4.2 to 4.35%. That gap matters, and the reasons behind it are going to shape your decision. I'm Aguinaga, your Montreal real estate expert. I've been guiding buyers and investors through rate cycles for almost 18 years now, including the 2008 crisis, the pandemic boom, and the rate shock of 2023. I've seen what decisions cost people in the real world. Let me break it all down for you. Here's why fixed and variable rates are diverging. This is the key concept for 2026. And once you understand it, everything else makes sense. Variable rates follow the Bank of Canada policy rate. The Bank of Canada holds at 2.25. Banks set their prime rate at 4.45, and your variable rate is prime minus a discount. Simple. As long as the Bank of Canada holds, your variable rate does not move. Fixed rates are a completely different animal. They follow the 5-year Government of Canada bond yield, and bond yields do not care about the BOC. They care about inflation expectations, global risk, and investor sentiment. Right now, bond yields have been climbing because of the situation in the Middle East, pushing oil prices higher, ongoing tariff uncertainty with the US, and inflation ticking back up to 2.4% in March. That is why fixed rates have moved up 25 to 40 basis points since mid-March, even though the BOC did absolutely nothing. So you have this unusual situation where variable is cheaper today, but fixed is rising because markets are nervous about the future. That tension is what makes this decision hard in 2026. Let me show you what this looks like on an actual Montreal mortgage. We're gonna use a $600,000 mortgage, which is realistic for our market right now, where the average home price hit about $657,000 in March, according to the Centra's data. 25-year amortization, 2 scenarios. Scenario A, a 5-year variable at 3.6%. Your monthly payment is approximately $3,030. Over 5 years, assuming the BOC holds and nothing changes, you pay about $100,000 in interest and reduce your principal by $81,000. Scenario B, 5-year fixed rate at 4.2%. Monthly payment is about $3,220. That's about $190 more per month. Over 5 years, you pay roughly $117,000 in interest and reduce your principal by about $75,000. The difference? Variable saves you approximately $17,000 in interest over 5 years if the rate holds steady. But that is a big if. Let me stress this. What if the BOC raises rates by 50 basis points in late 2026 or early 2027, which some forecasters like Scotiabank and Desjardins are now flagging as possible? Your variable payment jumps by about $175 per month. The savings shrink. And if they raise a full percent, variable and fixed end up roughly the same over 5 years, except you had the stress of watching your payments change. Now, here's the part that I think is the most important and the most overlooked: break penalties. Life happens. People get a new job, they get divorced, they have a baby and need more space. In Montreal, people move. And when you break your mortgage early, the penalty is very different depending on whether you are a fixed or variable rate holder. Variable mortgage, the penalty is almost always 3 months of interest. On a $600,000 balance at 3.6%, that's roughly $5,250. Manageable. On a fixed mortgage, the penalty is the higher of 3 months of interest or the interest rate differential, the IRD. And the IRD formula that big banks use can produce penalties of $15,000, $20,000, even $30,000 or more on that same $600,000 mortgage. If you break a fixed mortgage with 3 years remaining, you could be looking at $15,000 to $25,000 in penalties. That is the price of certainty, and most people do not find out until it's too late. A tip here: if you go fixed, consider a monoline lender or credit union. Many of them use a fairer penalty calculation than the big banks. This is exactly the kind of thing your mortgage broker should be walking you through. So, which one wins in 2026? Here is my honest framework. Go variable if you have cash flow flexibility, meaning $175 per month increase would not hurt you. You think you might move or refinance within the next 3 to 4 years? That penalty savings is massive? You believe rates will hold flat or eventually come down once geopolitical tensions ease? Go fixed if you are a first-time buyer and your budget is tight. The certainty matters more than savings. You're anxious about rate changes and it affects your sleep. Financial peace of mind has real value. You are locked in for the full 5 years and unlikely to break early. Or you believe inflation and global instability will push fixed rates even higher, locking in now at 4.2 could look smart in hindsight if fixed rates hit 5% by the fall. And one more option people forget, a shorter fixed term. A 2 or 3 year fixed term rate is often lower than the 5-year fixed, and the penalty exposure is shorter. If you think clarity will come in the next 2 to 3 years, and honestly, it should, it's very likely, a shorter term gives you the best of both worlds. Let me bring this home to Montreal. In our market right now, single-family homes are selling in 39 to 45 days. Plexes just as fast. Prices are up 5 to 7% year over year depending on the segment. If you're buying in a competitive situation and you need your financing to be airtight, a pre-approval with a 120-day rate hold is your best weapon, regardless of whether you go fixed or variable. For the 1.2 million Canadians renewing this year, many of you locked in at 2% or lower during the pandemic. Your payment is going up no matter what. The question is not how to avoid the increase, it is how to minimize it. Shop around. Do not auto-renew with your current lender. The data shows that around 28% of renewers are switching lenders, and there is a reason for that. There is no universally right answer in 2026, but there is a right answer for your situation. It depends on your budget, your timeline, your risk tolerance, and your life plans. If you're buying or renewing and you want someone to walk through the numbers with you, not just sell you a product, book a call with me. The link is in the description down below. Again, I'm LJ Aguinaga from LJ Realties. I've been through every rate environment this market has thrown at us, and I'm here to help you navigate this one. Thank you so much for watching. I can't wait to see you on the next one.